Taxes, taxes. So I get this question a lot. Do I have to pay taxes when I sell my house? I don't know. Talk about that in a minute. Hey there, this is KG. I'm a realtor with Fairfax Realtor in Grimmett, where we help buyers to buy their dream home and sellers to sell their houses. And we do this in the Maryland, DC, and Virginia region. So if you're looking to buy, sell, invest in real estate, contact us below. We'll take care of you. And don't forget to subscribe to the channel to get updates once we upload a new video. So in the year of high equity, people are making money when they sell their houses, $300,000, $400,000. I actually had a client in 2021 that made over 300,000. So the question is, do I have to pay tax when I sell my house? I don't know, I'm not an accountant. So continue a tax series. I'm going to ask Zoe to answer that question. Zoe, first introduce yourself again.
Hey everybody, how you doing? It's Zopia of Luminous Accounting and Consulting here with KG again.
All right. So that's always a question. Do I have to pay taxes when I sell my house?
Well, the answer, like always, is it depends, right? So generally, you from the general idea is that you do have to pay taxes when you sell your home. However, there are provisions for excluding some of that capital gains, right? If you have a capital gain on a sale of your home, you may qualify to exclude up to like 250,000 or 500,000 of that gain if you're married from that sale. It just depends on certain circumstances.
Okay. You just said capital gain. That is accounting lingo. What does that mean?
Capital gains is right. It is the sale of capital, the gain on the sale of capital. So, I mean, in simple terms, it means if I bought my house at 100,000 and I sold it a year later for 150,000, the 50,000 additional of profit, that will be considered capital gain.
Ah, okay. So to digress a little bit, when you talk about that, capital gain. So if I buy a house, you bought a house for 100,000, year later, or whenever you're now selling it for 150, you have 50,000 in capital gain. Is that going to take into consideration the repairs, the upgrade that you made in the house?
Well, yeah, it actually would. So if you made upgrades and repairs into the house, that increases what is called the cost basis of the property, right? So we said you bought a house for 100,000, right? Now, if you make significant repairs and improvements, maybe it's like 10,000 more. Now the base of the house is 110,000. That's how much money you have in the home. Okay. So when you sell it for 150, now the capital gains instead of 50 is 40.
Oh, okay. Just want to get out of the way. Okay, so let's talk about paying taxes on sale of my house. So talking about different scenarios, I just said one of my clients sold his house last year and he literally made 300,000. And one of the questions he asked me is, do I have to pay tax? He is married, right? So if you're married and that property was his primary residence, he is married, so does he have to pay tax on that $300,000 gain that he had?
Yeah, so it really depends on whether or not you qualify for the exclusion. That because he's married, he's looking at trying to qualify for 500,000 in exclusion, meaning that potentially he can have zero taxes on all that 300,000 capital gains. Okay. Now there are 5 qualifications that you have to kind of go through. Okay. And we can go through each of them step by step if you like.
Okay, so to qualify, before we go there, to qualify for that he will not pay any taxes on that $300,000 and is married, there's 5 things that he has to, steps that he have to make sure. Okay, does that apply also if is a single person? If say a single person sold the house, make 500,000, 200,000, let's just say 300,000.
Now, for a single person, the requirements are still the same, but the exclusion amount is different. That exclusion amount is now 250,000 instead of 500, so 250 per person.
Okay, 250 per person. Oh, okay. So what happened if okay, primary, we're still talking about primary resident. You're married, you pay your tax, you file your taxes different, filing separately. But then the income, I mean, the capital gain tax from the sale of the property is 450, let's just say 450. How is that going to work?
So when you're filing separately, think of married filing separately as you're, from a tax perspective, you're going back to being single. So when you're filing separately, each person's capital gain exclusion is only going to be it's only going to be 250,000.
Okay.
Now, yeah, so depending on who owns the property, you may be able to split it between the two, and one person gets 250, the other person gets 250.
Okay.
Yeah, or you can claim it all on one, and then that's just up to you.
Okay. So, but does that, okay, that's just for primary resident, as in the houses that you're living in, right?
Yeah, so it's on, the main requirement is that it is a primary residence, a home that you use for residency. There are some exclusions with that, with when you consider homes that you live in that also have some business purpose. Like if you live in the house but you rent out a room or you rent out an area of the house. There's also,
with Uncle Sam.
what do you say?
What does that got to do with Uncle Sam if I rent a room?
Uncle Sam wants every part of everything that you do. So it's best to report things appropriately, right? So just like you use your room to generate income, whenever there's a Uncle Sam sniffs somebody generating income somewhere, there's typically a tax provision around that. So in this case, Uncle Sam is actually being favorable to you because what he says. Yeah, what he says in this case is that if I own a home, I live in the home, and I rent out some rooms in the home, I'm still going to be eligible for the exclusion, even though portions of my home are used for business.
Okay. So it's not actually negative, it's positive.
Yeah, it's positive for you. Yeah.
Okay. Just want to make sure. Okay, so that's for primary resident, but you said there are 5 things that you have to go through, or exception to make sure they can get that.
Yep.
Not to pay taxes. What are the 5 things?
5 things. One is is the auto disqualification test. That is saying that if these things are true, then you automatically cannot qualify for the exclusion. And those two, one of those is a 1031 exchange property. If you receive this property as a 1031 exchange in the last 5 years, you're automatically disqualified.
Okay.
1031 exchange is I guess a CPA word or a tax word.
Well, I always tell people, if you don't know what I'm talking about, don't worry about it. One exchange, right?
Yeah. So yeah, but then the second thing is that if you're subject to expatriate tax, and that's just if you're living outside of your native country, and you're subject to that specific tax, then you won't qualify for this exclusion. So it's for native bred U.S. citizens, I think for U.S. Not citizens, but those who are qualifying for to be in the U.S.
Okay, hold on. So what you're saying is, if somebody visits United States, and I have clients like that, they don't live here, they visit here often, sometimes their children go to school here, then they decide to buy a house. If they're selling that house, if they sell that house, they have to pay taxes on the
Perhaps it really just depends on where your native country is and probably where your residency is. I can't speak extensively into the expatriate tax provisions, but just know that if you have to pay expatriate tax, then you are disqualified from this exclusion.
Okay, number 3, right? Just 3.
No, that's number 1. Those are 2 ways to be disqualified.
Oh, okay.
Yep. And then number 2 is the ownership test. This is one of the more important ones. If you own the home for at least 2 years leading up to the date of the sale, within the last 5 years, you meet the ownership test. So out of the last 5 years, let's say I'm selling it today. That means 5 years ago, within the last 5 years, did I own it for at least have I owned it for 2 years? Then it says, yes, you meet the ownership test. The reason why that's important is because you could rent a property for 3 years and then buy it, or rent it for 4 years, buy it and try to sell it. So 2 years ownership for the ownership test.
2 years ownership, living in as a primary resident, right?
As your, yep. Well, that's the next test, but yes, this is not the primary residence.
Go ahead.
The next test is the residence test, right? That's if you lived in your home as a primary residence for 2 out of the last 5 years, right? Then you qualify. And so, and one of the cool things about this is that it doesn't have to be consecutive days or years. You can actually like check mark every day that you lived. Maybe you lived in it a year on year 1, maybe on year 3, you lived in it for 6 months. And then year 4, you lived in it for another 6 months. You add all those up and say, collectively, in the last 5 years, I lived in this house for 2 years, or it was my primary residence. And so then you can qualify for it.
Oh, okay, okay,
yeah.
Okay. That would take me, okay. That's number 3, right?
Yep, number 3. And then one thing to keep in mind here is that if you're married, right, the ownership test or that ownership requirement has to be met separately by you and your spouse. So both of you have to
jointly.
What do you say?
If we're filing jointly.
Yep. Even if you're filing jointly, you have to have it on file. You have to know that both of you have lived here and use it as your primary residence, primary residence for the last 2 years. So if you use it as your primary residence and then your spouse left and they lived in another state, separated, not legally separated, but maybe just separated, they disqualify themselves from taking the exclusion. And so you probably can't take, your exclusion may not be, maybe limited.
500,000, okay.
Yep, it may be limited because, when you join together, it's 500. When you separate, it's 250.
Okay, okay. Good to know.
Number 4 is called the look back test. And so that just means that, did you sell another home during this 2-year period before the date of this sale, right? So it's really not really centered around whether or not you sold the home, but rather, did you use the exclusion already in the last 2 years?
Last 2 years. Oh, okay.
Yeah. So you can't use it every 2
years.
Yeah, so you can't be moving houses, flipping homes, and then excluding your gains every single year.
Okay. Last one on the list, number 5.
Yep, the last one is just really speaking about exceptions to the eligibility test. These are unique circumstances that may cause, that may defy what we just talked about, the last 4, or they may bring up situations or circumstances where your exclusion can just be limited instead of completely gone.
Okay.
Right. And some of those situations are 1, if you're separated or divorce occurs. 2 is if you have a death of a spouse.
Okay.
3 is if the sale of a land, the sale involved a vacant land or vacant property.
Okay. You cannot live in a vacant property.
Yeah. 4 is your previous home was destroyed and condemned.
Okay.
5, you were a service member during your ownership, right? And then the last one is business use of the home. Similar to how we just discussed that if you're renting out, like a room in your house, or if you want to, if like last year or the last couple of years you rented it, but this year you use it as a primary residence, there's certain provisions based on those specific scenarios, and they have a whole calculation on how to determine how much of the exclusion you're eligible for.
Okay, so that's for primary residence, right? That means
yes.
Okay, so for somebody that is selling their house that is no longer a primary resident, was a renter, so they live in the house, right? A lot of my clients do this too. They moved out and they rent the house. The house was rented for 3 or 4 years. Now they're selling it. Do they have to pay tax, or can they take that exception?
Yeah, so it goes up to the very first rule is the the residency rule,
Mm,
right? If you rented it for 4 years,
mm.
you only lived in it one qualifying year, and so you're not going to be able to take that exclusion.
Oh,
Sometimes, yeah. So there's also, let's say it happened. Let's say like you. So there's other ways to parse like the rule, because you can sell it at the middle of the year and
mm,
maybe you rented it out earlier in that year. What
mm,
you have to essentially do is just to the block of times that it's rent that is was a primary resident and that it was a rental, you're
mm.
going to have to figure out which time periods qualify.
Oh, okay.
Which
So
time
that
period
you
qualify.
flip over. Okay, okay,
Right. Mhm.
okay. So you still have to pay tax. So if you buy it primarily for renting, for investments, which is what we do, right?
Mhm.
And now over the years, you've charged tenants, you make money, and now you're selling it. You have to pay taxes.
It depends on how long did you live in it, right?
You
If
never
you
lived
live
in
in
it.
it,
You never lived in the house. You never
if
lived
you
in
never lived in it, yeah, if you never lived in it, you
it.
should expect that you're gonna pay. You won't be able to use the exclusion. The exclusion is really just for primary residents primarily. And so
Mhm.
that's really where the tax advantage comes into play. So, there's this thing that actually goes around that people or this concept that investors may use where they rent out the house that they actually live in
Mhm.
instead of buying a home. And so there's a debate on whether it's better to rent or whether it's better to buy,
Mhm.
right? If you rent, you don't have an option for this,
Yes.
right?
Mhm.
So this can be a great wealth building strategy for anyone who's investing in real estate, whether you're buying rental properties or you're fixing and flipping for your home that you actually live in to be an investment play as well.
Okay, that's a good one. Um, Vacation home
So
in Vail or in Ocean City. I have a condo. I'm renting it. I go there every few often. But now I want to sell it. Do I have to pay taxes on capital gain?
So for the vacation home, it's only gonna be eligible for the primary home, right? So vacation properties, rental properties, those are gonna be treated as business use. It's not gonna really be treated as your primary residence. So it's really just for primary residence.
So there's no way around vacation home, second home. I mean, because people do that, right? I have second home, though it's not my primary residence. Now I
Mhm.
sell that second home. I cannot take primary resident exception on that one.
There may be some calculations to do where you are able to divide your home based on whether or not you used it for rental or vacation for rental periods, like for renting the home. And then you may be able to take a portion of the exclusion, but it's really primarily for the primary residence that you have. And
Mhm.
then you also got to think about the fact that when you use it, if you use the exclusion, you
Mhm.
only can use it one time in 2 years. And so it's not something that you can just use every time you sell a house. Like,
Exactly.
it's really like, okay, in specific situations, it's probably good to use it. And vacation home, it would fail a lot of the test, like the qualifying test. I
Uh,
mean, you own it,
mhm.
and you're not disqualified, but the residency part of it, you're not gonna qualify for that.
Oh, okay. Okay. All right. So that's the question. That's the answer to your question. Do I have to pay taxes when I sell my house? Yes and no, right? So
Yeah, yeah, it depends.
it depends. Okay, that's the accountant's lingo. It depends, right? All
Yeah.
right. So listen, if you want to find out if you have to pay taxes before you sell or even after you sell, contact the accountant. It will let you know. Every person's financial is different. So Zoe, please drop your contact again.
Yeah, so I'm Zopia, owner of Illuminate Accounting and Consulting. You can find me at illuminateac.com or on all social medias, ZOKPIA. You can Google me, ZOKPIA. I promise you, I'm the only one who's going to show up, and you can find us there.
All right. So listen, like I said, if you want looking to buy, sell, move, sell in the DMV area, if you're going to pay taxes, just still sell it. Contact us below. We'll take care of it. And don't forget to subscribe to the channel to get updates once we upload a new video. Ciao.